Welcome back. I'm Pratap here. Today is 19th August 2024. In this video, let us evaluate the performance of high liquidity zones generated by the NeoStock software in our previous report. So let's look into their trades in today's live market. Even before that, please understand we are providing complete free training on supply demand zone price action. All the training lessons are available at our NeoStock YouTube channel. So at our channel, you click on this community tab, you get access to this post which describes our free training program. And this post is also having a YouTube playlist link that will take you to all the training videos. You just click on this link. I'm clicking on the link. Now we are into the playlist Supply Demand Zone Price Action course. Here you have all the training lessons are available. So far 24 training lessons are released. And from these 24 training lessons, you have 62 training videos are available. And you need to start your training from lesson 1.1. For that you need to scroll down to the bottom of the page. Here starting from lesson 1.1, all the training videos are available in an order. So please go through all these lessons one by one, starting from lesson 1.1. and strengthen our skills related to supply demand zone price action. I have also provided the link to our Telegram channel in this YouTube video description. So please join at our Telegram channel from this video description. It will be helpful to you each time when we release a new video, YouTube video or any other important updates we will provide at our Telegram channel. So this is about our free training program we are offering about supply demand zone price action. You know that it is a highly expensive training program, but we are offering complete free training. Now let's get into the analysis of the high liquidity zone generated by the NeoStock supply demand zone software. So yesterday we identified, yesterday means the previous trading day, that is the Friday end of the day, we identified 4 high liquidity zones for our today's trading purpose. Out of these 4, we got a trade in Nifty Mid Cap Select. Actually, I need to admit a mistake I have done in today's morning at our Telegram channel. So please ignore that post. I did a small mistake. I don't know what happened to my analysis. All of a sudden, I made a mistake. I have drawn a demand zone as a supply zone with a red color. And suddenly, I believed it is supply zone. Luckily, got a trade from that area. But actually, it's a mistake. That's a wrong analysis. Just ignore whatever I am going to explain in this. Please focus on this analysis. This is accurate. Later on I realized it. It's a rare mistake I did today. Anyway, today this is a Nifty Mid Cap Select. So this is a daily high liquidity zone. This is listed in F&O category. So our software identified this as a leg-in. See the hidden body. After adding the hidden body, this is going to be a medium size candle. So it is a leg-in. After that 3 base candles, and then again add the hidden body. This is going to be a drop candle. So this is the way our software identified this zone. And this daily high liquidity zone, I fine-tuned with 75 minutes time frame. So here in the 75 minutes time frame, you have a drop candle, and then you have 2 base candles, and again you have a drop candle with hidden body. So if you add the hidden body, it is going to be a very big drop candle. And moreover, there is a pro gap here. This is the important point we should observe. There is a pro gap. That means there is a higher chances this zone is having a very strong order flow. That is what we experienced in today's trading session. Okay, anyway, this 75 minute zone again fine-tuned with 15 minutes time frame. See, we have a rally base drop. Rally base drop. Again with hidden body, this is going to be a drop candle. So again we have a pro gap. Now again in the 5 minutes fine-tuned, in the 5 minutes time frame, here we have a rally candle, 4 base candles, and again a drop candle with the hidden body. So we have a pro gap is there. So from this pro gap, if the order flow is very strong, probably institutions, it will pick up the orders from that area where the pro gap. Let me tell you the mistake I did today morning. I have drawn, actually this is a demand zone, drop base rally, follow through candles. Mistakenly I have drawn this supply zone exactly from this area because this is in the pro gap area. See, this is also below this also pro gap, above this also pro gap. Luckily from this area it picked up the orders today. This is a mistake, you cannot draw this. This is supposed to be a demand zone and this demand zone is already violated. This rally base drop with pro gap, this has violated this demand zone. That way it got zone achievement. I don't know what happened today morning. Just I made this mistake. Drop base rally, I drawn this with red color. Later on I thought this is the institutional order flow. See, exactly from there it picked up the orders today, near to that. From there couple of trades came. This is the first one, this is the second one. But actually it's a lucky, if any, okay, I made a mistake, I admit that. And from that mistake area only it picked up the orders and it came down. It is not that it is having an order flow in this zone. Actually this is not a valid zone at all. But here pro gap area institutional order flow is there. So actually the pro gap area institutional order flow is started from here. Strong order flow. Whichever the demand zone we have broken, from the demand zone, the pro gap, the institutional order flow has started. That's why this trade worked out today morning. But actually, this is not a valid trade as per our supply demand zone. Let me delete. You can take a trade here, there is nothing wrong. But where is going to be your stop loss? Your stop loss is the 5 minutes fine-tuned zone. The distal line is the stop loss. You can take an entry here. You can take an entry a little above. You can take an entry a little below. Because this entire area is pro gap. But the problem is our risk management. You won't get a valid risk management. Taking an entry here and this is the target, you will get only 1:1 RR. At least a minimum 1:3 RR should be there. If you are a highly experienced trader, even you will accept 1:2.5 at some times. But you get only 1:1 RR you will get if you take a trade from here and your stop loss is a little above. Because of my mistake I did. In today morning in my analysis, in a hurry, I made a mistake. I should admit my mistake. I made a mistake. Because of the mistake, and luckily it picked up the orders from that zone I have drawn with mistake. It looks like a successful trade, but actually it is not correct. Strictly speaking, it is not correct. According to our supply demand zone, there is no valid zone in this area. Later on, a zone is created in the dynamic market. The first trade, whatever I explained in today morning at our Telegram channel, that is not a valid trade as per our supply demand zone. But here institutions created a new 15-minute zone in today's live market. In lesson 21 I explained dynamic zones. Exactly that concept is executed today, luckily. So we have a rally candle. Why it looks like a drop? Why I am saying rally? Because the moment you add the hidden body from here to here, you add the hidden body, it will become a rally candle. That way you need to understand this candle. That's why understanding, because I explained in lesson 9. I think in lesson 9.3 and lesson 9.4, in both the training lessons I have explained about hidden body and hidden zones. Exactly that concept you have to apply. So it is a rally, and then you have a base candle, and then again you have a drop candle. This is a ERC candle. It looks like a failed ERC candle. Failed ERC candle, only some special scenarios you can use. A leg out, then you have a follow through candle is also there. So it's an excellent. Especially the body should come out of the zone. That is what we got, a sufficient body, this candle. And the body has completely come out of the zone. It should not close inside the zone. I will explain these special scenarios in one of the training lessons in the coming days. But time being, remember this scenario. Especially ERC candle, failed ERC candle, when you want to use as a leg out, the body should completely come out of the zone. It has completely come out of the zone. Sufficient enough. Wick to wick you have to draw, wick to wick you have to draw, and then body should completely come out of the zone. Wick to wick. You should not forget this point. See, here I have drawn the zone, 15-minute zone, wick to wick. When I draw the zone wick to wick, the body completely come out of the zone. So you can consider, this is a ERC candle, this is a bigger than the medium size candle. Because it is a bigger than medium size candle, if it is a medium size candle, probably it will qualify as a base candle. But this is a very big, the big wick is also there. So bigger than the medium size, anything bigger than the medium size candle, maybe this is a medium size candle. Compare it to this is a big candle. See, huge wick up to here it is there, from here to here. So anyway, this is the way you can draw. In case if anybody convinced, this is the 15-minute zone, this is also a medium size candle, if you convince like that. See, there is no rule that I should deny it is a medium size candle. If you convince. According to you it is. But once your experience grows, see, these are all some of the candles are at the boundary conditions. Boundary conditions means you set up a rule, compare to a rule, it is a little bigger, very little. At the time you get a confusion, whether it is a medium or like. But anyway, I am fully convinced with follow through candles are there. If you are not convinced, you will draw a zone like this, 15-minute zone. You have a rally, 2 base candles drop. This is also you can consider. Okay, I am convinced with this approach. So no issues. Either way, it is okay. But the base, the institutional order flow area is very, very important. That is the base candles. And convincing leg out, a sufficient body should come out of the zone. So, okay, this body is whatever it is come out of the zone, it is okay for me to consider. And why I am more convinced, after that there is a very good follow through candles are there. And moreover, this order flow is important. And moreover, it is a 15-minute zone. We have to draw the 5-minute zone inside this by considering all these points. But actually, from where the prices are coming? From the pro gap area. See here, this entire thing is pro gap area. Somewhere here, if I want to take a trade in the pro gap, my risk management should support, because here we have a fine-tuned 5-minute zone. The distal line of fine-tuned 5-minute zone is your stop loss. And suppose if you take an entry here, this is going to be your risk from here to here. The same whatever length is there, almost same length is here. Probably you will get 1:1.2 or 1.3 RR you will get. So that is not acceptable, such kind of trades. So that is the reason why morning whatever the trade I told you, that may not be valid according to this analysis. Because I made a mistake and draw a demand zone, and instead of drawing the demand zone, I made it as a supply zone with red color. Later on I thought it is the entry. Exactly from there prices came down. It looks like everything looks like it is a perfect trade. Yes, it looks like a perfect trade because I did mistake in my analysis. But actually, it is not a perfect trade. The reason is it is not within the risk management. The trade worked. It gave you a very good profit. But still, because of the mistake, you are lucky. Because you are lucky, the trade worked out. But actually, it is not a valid trade as per the risk management. So that's why I am admitting that mistake I made. But still we got a trade from this zone. Because this is the dynamic zone. What is dynamic zone? A new 15-minute zone created during the live market. Next time in the retracement, you can plan a trade. See, a new zone is created. Again, it retraced. It picked up the orders from this fine-tuned area. And again, it came to the 15 minutes target zone. Okay, fine. How we fine-tune this area with 5 minutes? Again, the 5 minutes fine-tune is also tricky. Actually, this is the type 3 proximal fine tune I have done. Why I did like that, let me explain. So I'm going to the 5 minutes time frame. So here you have a rally candle, you have 1, 2, 3 base candles, and then you have a drop candle. How I am supposed to draw the zone? Like this. This should be the entry, right? But why I have taken type 3? The reason is risk management. When I draw the zone wick to wick, type 2 proximal, not wick to wick, I'm sorry. When I draw type 2 proximal, I'm not getting the RR, I'm getting only 1:1.8 RR. Even I'm not having 1:2. Less than 1:2. Even 1:2 also we don't take. See, always we take a minimum 1:3. Yeah, if you are a highly experienced person, okay, 1:2.5 is acceptable. Because of your experience and your risk management techniques, at least you can take. Even if your stop loss is hit, you will be in a position to bear that risk because of your high experience. Probably many of your trades will success. Once stopped out with a little bigger risk, it won't affect your trades. But if you are a fresher and recently you learned the concepts, protecting your capital is very important at this stage. Even if you miss the trade, it's not a problem, but a risk should be within your manageable level. So if I draw type 2 proximal, I am not going to get 1:3 RR. See, at present type 3, this is the type 3 proximal. See the RR? I am having 1:3.63 RR. Several times I explained how we need to achieve, but once again today also I will explain. If anybody missed, please listen carefully and learn this concept. In general, how do you draw? You draw a zone like this. So when you manage your risk, this is your entry. See how much? 1:1.74, close to 1:8 RR you got. One is to 1.78, close to 1:8 RR you got. Do you accept 1:1.8 RR? You need at least 1:3 RR. But 1:1.8 or 1:2 RR you won't accept. So do you want to leave this trade? No, you don't want. What you do? You adjust the entry. How you adjust the entry? By adjusting the risk. How I am going to adjust? Instead of instead of type 2 proximal, I am trying to change the entry. Type 3. Still enough order flow is there in this area. You may ask a question, suppose price did not reach. Within this type 2, it just touched and again came down. I will be missing the trade. You may say, yes, okay, you miss. Anyway, you can't take the trade because your RR is not sufficient enough. You will ignore the trade. But if you adjust to type 3, luckily prices enter and if you get a good trade, at least you will get a good profit on that day, right? If you miss, you have two options. There is a possibility you get the trade, and another possibility you miss the trade. If you miss the trade, no issues, because anyway RR is not supported, you would have ignored that stock. Suppose type 3, because of type 3 proximal, risk is minimized. Now the stock is within your risk management. Even if it hits your stop loss, you will be able to bear that risk. Because you are able to bear the risk, you are accepting the trade. Otherwise, you don't accept the trade, right? So that is the reason why type 2. Because of we adjusted this. Now see the 1.78 risk, the entry I am changing. See how risk is changing, RR is changing. See now 2.73, further moving up. See 3.4. Now let me keep my mouse exactly at this type 3 proximal. If prices touch the type 3 proximal, I take the entry. Otherwise, I don't take the entry. See now you are able to achieve 1:3.69. That means 1:3.7 RR you are able to achieve. Only when it touch type 3 proximal, then only I take the entry. Even I don't want to use any entry buffer also. Again, if I add entry buffer, there are higher chances risk will be reduced below 1:3. If it touch exactly the type 3 proximal, then only I will take. Otherwise, I will even if I miss the trade, I don't mind. Anyway, I added stop loss here, stop buffer I added. So with this stop buffer, with this entry, I am able to achieve 1:3 RR. Fine. So that's excellent. What about your target? Your target is 15 minutes. See here, you have a rally, you have 3 base candles and again a rally. This is going to be your new RR, your new target zone. Because here candle, you took an entry after that candle is completed. Even if you kept any of the, whatever analysis, any of the 15-minute zone below, now you have to adjust. Because this is the most nearest to the current zone. If you feel prices further will go down, this will be reduced. If you feel like that, you will use a trailing stop loss, either 1 minute trailing stop loss or 5 minutes trailing stop loss. That way you can get more reward. But at least to the nearest, what is the profit we got? Let us calculate. Because till this 15-minute zone, we have at least 1:3 RR is there, 1:3.7 RR. This rally, base rally, 15 minutes demand zone. Now let me go to the 5 minutes time frame. See in which candle, at 11 o'clock 35 minutes candle, you got the entry. And the zone is slightly pierced, slightly, but within the stop buffer. Slightly, few paisa, that's it. After that, prices came down and finally reached the target at 12 o'clock 5 minutes. You got the entry at 11 o'clock 35 minutes 5 minutes candle. At 12 o'clock 5 minutes candle, it reached the target. That means within maybe 30 minutes, your trade is completed. Within 30 minutes, trade is completed. This is the second time. In the retracement, the first time when it entered into the pro gap, the point you should understand, it created a dynamic zone. That means live market, a new 15-minute zone is created. In that we have a fine-tuned 5-minute zone and we have taken a type 3 proximal next time when prices retraced. Why we have taken type 3 proximal? Because of the risk management. The zone is slightly pierced and it came down. Why it came down after piercing, you may ask? Because it is in the pro gap area. See, this entire area, a lot of institutional pending order is there from the pro gap area. I already explained about this pro gap, novice gap, pro gap in our phase 1 training program. I think in lesson 6, I have explained about pro gap and novice gap. See today, from the pro gap area, it is slightly pierced, still within our stop buffer. But why it came down after piercing? There is a strong reason. Because just above, a fresh pro gap institutional order flow is there from the pro gap. And because that area very strong order flow, it pushed. Even price action also, recently I explained, while placing based on the price action, how you can take the entry. See here, in this candle, a little above this candle, prices went and again came down. That point also you have to observe. Already in this area, a lot of order flow might be there. Because demand is such a strong, it consumed all the demand and moved out of this zone slightly and a little above that from the pro gap area. Pro gap area is a dark area. It's like a black hole. You never know what is there inside. There is a very heavy strong order flow might be there. That's why see the rejection, how it pushed the prices again. And within half an hour it reached the target. Sorry, actually it reached the target in 12 o'clock candle, not 12:05. At 12 o'clock, in this candle itself, prices came and again from here again there is a rejection, again came down. So that means in this candle, 12 o'clock candle itself, your trade is completed. That means reached within 25 minutes. So we can say 30 minutes. Within 30 minutes, your entire trade is completed. Okay, what is the profit we got? It has given 3,792 rupees profit. You may ask a question, why profit is very small? The reason is the margin cost is also very small. The margin cost is around 79,000, some 700 or 800 rupees. You can say close to 80,000 rupees. Generally your future will be having 1.5 lakh to 2 lakhs in between. Your future cost will be there. So probably you would have brought two futures. If you would have brought two futures, probably you would have earned around 7,000 rupees plus profit you would have got. You would have invested 1,60,000 rupees close to or a little below. And 3,792 into 2. So definitely more than 7,000 rupees, maybe 7,400 rupees something you would have got the profit. Or 7,500 rupees you would have got the profit. With the same capital, generally invest for the equity stocks. 3792 into 2. 7,584 rupees. That is what you got in the earlier trades. You see 8,900, 7,000, 8,700, 5,300. Because it is only 80,000, see the RR 4.8% RR you got. See here 4.9% RR you got 8,924. Because the LTF cost, maybe the future cost was around 1.5 lakh. Probably here also with the same amount, you will be getting the same value, 7,500 rupees profit. Here 4.8% ROI, here also 4.8 ROI. Here you got 7,000. Here with 2 lots, you would have got 7,000, maybe 7,500. So this is how you should understand. So mid cap Nifty, the future margin cost is around 80,000, just a little below 80,000. Okay, this is about Nifty mid cap Nifty in futures. This is the one successful trade we got. Because of my mistake, 2 trades we would have got today, but that is not acceptable. Mistakes should not be acceptable. And the next one is the remaining 3 stocks we didn't get the trade, and 1 stock zone is violated. We know that the zone is violated. I will tell you those reasons. The first one, let us look into the Divis Lab is a high liquidity zone, and also it is supporting bullish trade setup. This is a daily high liquidity zone and also supporting bullish trade setup. So our software identified this stock. This is a ERC candle, rally, base, rally, 2 base candles, rally. This is the high liquidity zone, or maybe rally, base, rally also. This is also considered rally, base, rally. Okay, anyway, this is the high liquidity zone, daily high liquidity zone, and also it is a bullish trade setup also it is supporting. The same daily zone also supporting bullish trade setup. And moreover, it is a fresh zone. So I fine tuned with 75 minutes time frame. In the 75 minutes time frame, so I have identified a rally, base, rally, and a huge follow through candle. So this itself is enough as a rally candle to qualify. But this is much bigger. So because it is much bigger, this looks like a small candle. Let me hide. You will get clarity. See here. You have a rally, base, rally candle. Okay. This is the 75 minute zone. So within this 75 minute zone, again fine tuned with 15 minutes time frame. In the 15 minutes time frame, you have a drop candle, legging, a base candle, 2 base candles, and a leg out candle, 2 base. So entire zone you can draw as a 15 minute zone. Or you can also consider rally, base, rally. That way also you can consider, either way. Now that again fine tuned with 5 minutes time frame. We have 2 fine tuned 5 minute zones here. See, we have a rally, 2 base candles and a rally. This is one fine tuned 5 minute zone. Again you have a rally, 3 base candles and again a rally. So these are the 2 fine-tuned 5-minute zones. But today prices did not get into this zone, so we didn't get a trade. So this is what happened today in the daily time frame. So we have to wait and see. In today again our software identifies at a little above price closed. According to the software calculations, if we miss, probably it won't be visible in our list, or if the distance is within the acceptable level, probably software will once again will identify. We'll see in today's report once it is generated at the end of the day. Today's after the market hours, probably evening 6 or 7 o'clock, the data will be ready. Okay, this is about Divi's lab. Next one is L&T Mindtree. This is also a daily zone, but supply zone. This one is a supply zone. We have a drop, we have 2 base candles, again a drop with the hidden body. You need to add the hidden body. This is going to be a drop, very big drop candle, drop based drop. So this is what our software identified. This is the fine-tuned area. I have identified a 75-minute zone. We have a drop candle, 3 base candles and again a drop candle. Again you add the hidden body from here. If you add the hidden body, this is going to be a drop candle. This entire wick will become a drop. So this is going to be a drop candle. As you learned in lesson 9.3 and lesson 9.4. Hidden body and a hidden zone concept you learned in both the lessons. So that way we have identified as 75 minutes. This 75 minutes again fine-tuned with 15-minute zone. See here you have a rally candle, you have a base candle with the hidden body. This is looking like a rally but not rally, it is a drop candle. With the hidden body, you add the entire this wick and even the gap, everything. If you add the body, this body is good enough to consider it as a drop candle. And what about this body? You have to ignore this body. This itself is good enough. So that's why, considering this as a rally based drop, this 15-minute zone is identified. But within the 15, I didn't draw the 5-minute zone. That means the 5-minute structure is not good. Let us look into the 5 minutes. See here, you have a rally, you have 1, 2, 3, 4 base candles and you have a drop. Okay, anyway it is a medium size candle, drop. You can ignore, but this is a failed ERC. See, very big candle this one. Next one is even much bigger, forget about it. But this is good enough. Previously I have drawn a drop candle or in Nifty mid cap select. So you can ask a question, can we draw? Because there also failed ERC, but we have drawn the zone. Here also failed ERC, can we draw the zone? This is the question you can ask. No, this failed ERC is not qualified as a leg out. Why? The reason is, I told you draw a zone wick to wick. If you draw a zone wick to wick, the body should come out of the zone. See, the body is closed inside the zone. It has to come at least a little, not exactly at the distal line, a little below the distal line. Further it should come down, at least up to here. Let me draw a zone, at least to consider. Let me draw a horizontal line here. At least the body is closed till this blue color line. I would have considered this as a leg out candle. When I draw wick to wick, the body should come out of the zone. But have you seen the body came out of the zone or closed inside the zone? Closed. So in that case, I don't consider this as a valid leg out candle. So I will ignore this entire base. I will ignore this entire base. So it's not a valid base. Okay, now I have a ERC candle here. I have another ERC candle. I can consider this as a leg in. I can consider this as a leg out. This is a drop candle. Why this is a drop? At the hidden body. The moment you add the hidden body, this entire thing is going to be a drop, very big drop. So here you have a ERC candle. You have another ERC candle. In between, are there any base candles? No. Without a base, where is the institutional order flow? Because there is no institutional order flow, I cannot draw a 5-minute zone here. So this is the reason why I didn't find a valid 5-minute zone here. When there is no valid 5-minute zone, there are higher chances that this zone will be violated, this entire fine-tuned area. Still we are within high liquidity zone, but we don't have any fine-tuned zones within this area. Probably tomorrow, maybe this zone will be violated tomorrow or day after tomorrow or in the coming days. Unless institutions create a new 75-minute zone inside this in the live market, and that is having a fine-tuned 15 minutes and 5 minutes. Next time in the retracement, we get trading opportunity. But as on today, there is no proper order flow here. Because there is no proper order flow today, see what happened, this zone is violated. Which zone? The 15-minute zone and 75 minutes fine-tuned areas is violated. Prices closed still inside the daily high liquidity zone. But today the fine-tuned area is violated. The reason, the fine-tuned area is not having fine-tuned 5-minute zone. That's why always I say, if you don't find a fine-tuned 5-minute zone, there are higher chances it will be violated. See, today the price has moved because there is no proper order flow. There is no push. Generally what high liquidity zones will do, it will push the prices down. But that didn't happen to this stock because there is no institutional order flow. Probably this entire activity could be the retail traders' activity. Institutional participation is not there in this area. So this is the reason why L&T's fine-tuned 75, fine-tuned 15-minute zone is violated. Because fine-tuned 15 is not having fine-tuned 5-minute zone. It is not having. That's why it is violated. So this is the reason why I have introduced this concept. Always you have to check order flow until the 5 minutes time frame. In lesson 20 in the checklist, I have given this important point as part of the checklist. Take trades only if you find fine-tuned 5-minute zone. Not only high liquidity, even bullish or bearish trade setups, fine-tuned 5 minutes is not for taking trade in the fine-tuned area. It is for confirmation that there is an institutional order flow. In bullish areas, you may take entry at the daily zone if it is monthly income trade. Daily proximal you may take. You need not go up to fine-tuned 5 minutes area. When you go to fine-tuned 5 minutes or 15 minutes area, if the risk management is not within your accepted, at the time you will choose fine-tuned 15 minutes as an entry or fine-tuned 5 minutes as an entry. If risk management permits, you will take a little earlier because there are higher chances prices may not go up to fine-tuned area. Before itself it will turn and it will go down if it is a supply zone. Or if it is a demand zone, it will turn and it will go up. Due to that reasons, in lesson 20, I have clearly explained fine-tuned area is only for verification of institutional order flow, but not for taking the entry. That is bullish and bearish trade setups. But in high liquidity setup, whatever the concept, high liquidity zone concept we defined for daily zones and 75-minute zone, definitely you have to take order in the fine-tuned 5-minute zone. Because it is an intraday trade, your risk management does not permit if you take trades at 15 minutes many times. At least out of 100 scenarios, 95 scenarios, your 15 minutes proximal entry doesn't permit the risk management. That's why always we look for fine-tuned 5-minute zone to manage the risk. See, sometimes fine-tuned 5-minute zone also, type 3 proximal only, helps in managing the risk. This is the best example what we have seen in Nifty Mid Cap Select. In today's analysis, I already explained you. The trade we took at type 3 proximal only in the fine-tuned 5 minutes. Risk management is very, very important. Even in high liquidity zones. We are very strict on that. Okay, this is about L&T Mindtree. Why we didn't fine-tune, not able to fine-tune, and also obviously the zone is violated. Because I already explained in lesson 16 all the scenarios about when a zone will be violated. Because 80% scenarios we are in a position to identify when a zone will be violated. That's why many stocks, we saved our trades, we saved our money. Even in this stock also. Because there is no proper fine tune, we didn't take trade. Otherwise, see what would have happened? It would have hit your stop loss today. But we didn't take a trade because it is not meeting one of our requirements. And the last one is a Lalpath Lab. In Lalpath Lab, this is a 75-minute zone, but from the year to 2022, I guess. This is the one. We have drop, base, drop. This is what our software identified. And legout is on 18th June 2022. The problem is we can fine-tune up to 15-minute zone. We cannot fine-tune 5 minutes because only in the recent price action we can fine-tune. But in 2022 we cannot fine-tune 5 minutes. TradingView in TradingView Pro Pack professional package, they give access only for 1 year. Last 1 year data. That means till 2023 August only you can access the data in TradingView. But this zone is created in the year 2022. So that is the reason why 5 minutes data is not available. So got it? So rally base draw 15 minutes zone is there. But 5 minutes I cannot fine tune. And recent price action also. There is no fine. See, recently prices entered. It picked up the orders from the fine-tuned zone, came down. But there is no 5 minutes zone is available here. Let me change the time frame to 5 minutes. See, recently prices went. We have seen a rejection. After that, it came down with a gap down. So there is no 5 minute zone. So that is the reason why we didn't plan any trade. Anyway, today prices also did not enter into this zone. So this is about remaining high liquidity zones, how I fine-tuned. So we got one successful trade, and that too from the dynamic zone we got the trade during the retracement. Okay, let's all meet again in our next video. Thank you.